Are you looking for the right policy for you, but you don't know where to start? By the end of this video, you'll know 7 elements needed to create a policy for max cash value. My name is Darius.
And I'm Carmen.
For the best infinite banking and financial advice, subscribe to our channel and hit the notification bell to be notified when we post new videos.
Analysis paralysis can really get in the way when it comes to you trying to make a decision for yourself. Therefore, we have created this video for you so that we can do all the heavy lifting. And we want to make sure that you are able to make an educated decision when it comes to choosing the right policy for you and your family. So let's get into it. These first 3 elements that we are going to go over are the most important elements that you need to take into consideration, because it doesn't make sense for you to proceed with getting a policy until you have the first 3 elements covered.
Element number 1, you want to make sure your agent has experience in designing policies for max cash value. And that entails knowing exactly how to create a policy for your specific needs. So you want to be able to give him or her what you want to get accomplished or your goals, and they create a policy specifically for you. So just a few questions you want to ask your agent is, do you have a policy designed for max cash value? What are some of the elements that you put into it to make it specifically for you? And what are some things you're utilizing your policy for? The thing I want to stress is you want to make sure you have someone that understands exactly what they're doing. They actually have experience in creating policies for max cash value. Because you don't necessarily want someone that is going to design your traditional whole life insurance policy tell you that they can create one for max cash value. Because for one, they may not have one of their own, and they don't necessarily understand the nuances that it entails.
Element number 2, are you working with a mutual life insurance company? Now, when we say mutual life insurance company, that means it's beneficial for you and the insurance company, because now you are an owner in that insurance company and you are able to participate in something called dividends. And what a dividend is a return of premium. After the insurance company has collected all of the premiums for the year and they pay their overhead, whatever is left over is returned back to all of the policy owners in the form of a dividend. Now, dividends are not guaranteed, but this is an amazing perk that you have to be able to grow your cash value when you are an owner of a mutual insurance company.
Element number 3 is loan interest. Before proceeding, you want to make sure you understand how much it will cost you to get a loan from this insurance company. We've seen it as low as 4% and as high as 8%. So before even proceeding on to the next step or getting your policy in force, understand how much it will cost you to get a loan from the company. And this is important to know, because if you have a loan that's as high as 8%, it's really going to affect your banking abilities.
Comment below and let us know what you're seeing for the interest rates on the policy loans. And don't forget, the policy is just a tool that is going to help you begin your banking process. So in order to understand how you actually use your policies, check out the video above where we talk about 10 ways you can use infinite banking. Element number 4, now that you've found an agent that understands how to design a policy for maximum cash value, and you're working with a mutual insurance company whose interest rates on policy loans aren't super high, we'd like to see it around 5% or below. Next is something called the base premium. And the base premium is your cost of life insurance. So the base premium is what provides you your death benefit. Now, the thing to take into consideration is the base premium should not exceed more than 50% of the overall premium. So the example is, if you have a premium that's $10,000, $5,000 of that should be base premium or less. Now, depending on your health and depending on your age, this will vary, but we just want to give you a rule of thumb that it should not exceed 50% of the overall premium.
Element number 5 is paid up addition rider. This is the portion of the premium that allows you to have cash value. So if the base premium is 50%, the other portion of it, which is the paid up addition, would be 50%. So if we refer back to a $10,000 premium, $5,000 of it will be your base premium. The other 50%, which is $5,000, will be your paid up addition rider, which is the cash value available in this policy. The paid up addition rider is the portion of the premium that we add to your policy so that you can have cash value in the very first year.
Now again, just to reiterate, when we're talking about designing a policy, there are going to be 2 mixes to it. You have a base premium and then you have the paid up additions rider. And then there's one other thing that can be added onto the policy, which is something called a term rider. Now, the paid up additions rider and a term rider are add-ons that we add onto this whole life insurance policy to provide you with more cash. But the thing that we want to clarify is that the paid up additions rider provides you with more cash value. The term rider allows you to increase the amount of money that you can add into the policy. It doesn't increase your cash value, it just basically opens up a window for you to allow you to dump in more cash that you don't necessarily have to pay on an annual basis. Now, the term rider is not for everyone. If you aren't planning on dumping in large amounts of money into your policy on an annual basis, then you don't need to pay for this rider to be on your policy. However, if you're an investor or if you're expecting a windfall of some sort, it may be helpful for you to add a term rider onto your policy so that your policy can accommodate the influx of cash that you're going to add to the policy without affecting your MEC limit.
Now, that brings us to the last element, element number 7, which is the MEC limit. The MEC limit is a formula created by the insurance company to let you know the maximum amount of cash that you can put into this policy without it becoming a modified endowment contract. If you go over this MEC limit, you will be taxed for the remainder of this insurance policy. So you wouldn't be able to borrow or make any withdrawals from the policy without paying taxes on it. So we want to make sure that you stay below that MEC limit so you don't have to pay any taxes on your whole life insurance policy.
All right, so now that we've reviewed the 7 elements that go into creating a policy designed for maximum cash value, it's just important that you understand these elements so that you can clearly articulate your needs when you're talking to an insurance agent. So now that you know these elements, what are you going to do when you actually get your policy? If you're ready to start your banking system, Darius and I would love to help you because we are licensed life insurance agents. So click on the link below to apply to become our client.
Also, if you want to join a community of like-minded high achievers just like yourself, we have a Patreon community where we share up-to-date information about infinite banking and how to navigate the tricky space.
And if you like this video, be sure to give us a thumbs up, leave a comment, and share this video with family and friends.
Remember to own your own lifestyle,
or someone else will.